Hey everybody, this is Jose Blasco. We are about to get started, about 40 plus seconds before we go. Let's use this time for a quick sound check. Best way to do it, we kill two birds on one stone. You type a quick hello message on the chat box, which is nice for the whole community, and everybody's happy to say hello to everybody. And now I know you heard me, so I know sound is good. So let's do that in those 20 seconds left before we get started, and that way we start on time. Quick message, everybody. How are you, my friends? How are you, everyone? I am just putting myself here. My place on the screen, bottom right corner. How are you all? Good to see you. Thank you, Maka, Christian, Joe. Good to see you all. Very good. Looking at the other streams as well. Yeah, all looking good. Perfect. Very good. Top of the hour. Time to get started. Everybody, we are live. Today is July 15, 2021. We're getting together to trade options. This is options with options. So we like to look at the market from various angles. Of course, we like to understand the direction in which the market is going. But for sure, with options, we also look at other things like implied volatilities, understanding how expensive or cheap options are, what's likely to happen to those premiums, and put option strategies to adapt and take advantage of the various changing market conditions. That's what we do. Before we get started, a disclaimer on the upper left side of the screen. Please read it carefully. This is important information. It's not too long, I would say, so you can go ahead and take a little bit of time to read it, and then you are well informed because it is indeed important. Mario, how are you? Good to see you. Very nice. Okay, so agenda. Hello, everyone. We just said we are simulcasting. Again, some of you know this by heart, isn't it? We always have new people joining our community of traders and traders enjoying technology, isn't it? And I have to kind of explain that we are simulcasting, and therefore, depending on where you're watching us from, so you may be in YouTube, you may be on our private room on the website tradewithufos.com/live. You may be using Twitch, you may be using LinkedIn, you may be using Facebook, and all those places have different latencies when it comes to how the videos travel through the video distribution networks. So keep that in mind when it comes to lags. And also, even though we don't do it too often with options, because again, options is a very, very special asset. There are many things to discuss, isn't it? But normally what we would do is on the public streams, we basically spend kind of half of the duration of the sessions in open, and then the full duration sessions can be attended on our private room on the website. Okay, so keep all of this in mind. Plan for the day, look at the market, understand what's happening. Have a little bit of a surprise. By the way, I want to start showing you some of the tools that we're going to start incorporating little by little. So we're going to start doing a little bit of deeper market analysis with some of those new tools as well. From there, talk about trade management, which should be very short today. I believe I should be right. And from there, we'll spend the remaining part of the session just looking for opportunities. Okay, Siderman, good to see you, my friend, as well. Fairmont, is very nice to see you as well, connected. Very nice, everybody. Perfect. Let's go for it. Let's begin. So here is our beautiful TradeStation. And what is happening today? Well, we're having a movement to the downside. Nothing major. It's negative 0.4%. So it's indeed not the end of the world. But what do we know? Well, we know that the next UFO is quite far. Okay, it's not too close in this case. Yesterday was different, and that's why we got bounces up and down. But those UFOs now are gone, and now there is open room for the market to fall, all the way to, let's say, 430 or something like that. And knowing what we know about the climate, which is, it's a very exaggerated climate at this point, with 16 candles into a climate that based on stats should be maximum 9. Well, certainly that indicates a strong possibility for a correction, maybe 3 days going down, something like that, and then go back up to blue. Okay, so careful out there, when it comes to understanding what we have. Okay, we never want to have biases, because sometimes we are wrong on the direction. So it's not like because we see the market potentially going down for 3 days or so, next thing you know, now we're gonna go out there and everything we do is shorting. We don't do that. We don't have biases because we could be wrong, right? But at the same time, it is useful to understand what the market is about to do, because in your accounts, you are running multiple positions. You should always be thinking of hedging yourself, right? So let's say you have 5 trades and all of them are long, and this is what we see now happening. So then it would indeed be useful to enter maybe 1 or 2 or short trades. So if the market does tank and your long positions are being hurt, at least you got a couple of trades helping to the downside, or vice versa. Okay, so it's important to understand what's happening overall to position yourself properly. From a premium point of view, okay, we are talking about 17% premiums today. Now the red UFOs we had yesterday are gone, and now what we have is green UFOs. So it seems that if this lines up very well with what we saw on the S&P chart, meaning that if premium goes down from 17 to this level, which is let's say 16.5. So from there, those UFOs should kick in and get implied volatility to go back up, which coincides with an increase of fear, coincides with the market falling, isn't it? So we have all of that. Okay, so in case you're wondering, today I'm going to start planning the trades, and we're going to start building on double calendars. Okay, because basically the only double calendar left we have in the account is PayPal, and that will expire tomorrow. So I would like to add some double calendars to the portfolio because we have iron condors, isn't it? So to balance out our Vega risk, we're going to be adding that, but we'll do that later. Now, I said I was going to use a few new tools as well when it comes to doing a little bit of market analysis. Okay, so I'm just going to come back here. Okay, I'm just going to come back here, and I'm just going to bring a new tool to the screen. My friends, it is my pleasure to introduce you to TOP. TOP is our new platform, which stands for Traddictiv Options Planner. It's our TOP platform. And this platform is gonna amaze you in many ways. Okay, but let's begin. So what is it that you get to see here? Well, first of all, you see the climate, and you know that. Next thing you know, you see UFOs, and you know that. So all of this, it's nothing new. It's the same tools that we use every day, which is our bread and butter. And thank God we have these tools. Now, what is it that I want to point at here today? As an initial approach to utilizing more advanced tools? Well, first, I want to show you here a tool which is nothing new. It's a measurement of implied volatility, right? So what happens with platforms like TradeStation, for example, is that you can go ahead and load an implied volatility chart, and it tells you what is the implied volatility of the options across the board for that particular market, okay? And in this case, it shows 13%. Okay. Now, with TradeStation, the first thing that happens is that value is not updated until the end of the day, and therefore today you are working with prior day values, and tomorrow you will work with today's values. Well, one of the enhancements that we have with TOP is that, number one, this implied volatility is a continuous implied volatility, meaning it's real time and updates during the day. So that's an improvement, but that's not where I'm going, okay? Because, Think or Swim, for example, has that, okay? You can have real-time implied volatility. But here's where now we're going to do something a bit more interesting, okay? So what I am charting here now is I am charting the real-time implied volatility for calls and puts separately, okay? For calls and puts separately. So in other words, all options, okay? If you think of their premium like a box, okay? And this is the calls and this is the puts, okay? So if you think about the premium of options like it's a box, you probably remember, I'm sure you know, that a portion of that, okay? Okay, is what is known as extrinsic value, okay? Or time value, okay? And the other part, okay, is what is known as intrinsic value, or real value. So anyway, so when it comes to the extrinsic value, okay, this is where the implied volatility is built in, right? So if a stock is trading, for example, let's say the S&P is trading at 435, right? So the S&P is trading at 435, and let's say you own the 430 call, so for sure you got $5 of intrinsic value there, no matter what, right? But the option will cost more than $5. The option will cost maybe $4.5. $5.5. Why extra 50 cents. Well, that's the extrinsic value or time value portion of the option, which has to do with many aspects, many factors, such as the amount of time to expiration, things like that. Okay, I mean, all of this is basic options knowledge. I understand that all of you know these by heart, but the point is, one of the components of the extrinsic value is the implied volatility. Okay, so in a perfect world, okay, and knowing, I'm just going to simplify this a bit, but in a perfect world, and knowing that there is something called dividends, and dividends are priced in the puts if they coincide with the expiration date when the dividends are released. So we often find the calls and the puts to be exactly the same value, because if I was to compare the 430 call and the 430 put, okay, of course the 430 call is in the money by $5, so it would be, let's say, $5.5. Okay, $5.5. But then the 430 put is out of the money, and therefore it has no intrinsic value, but it has the same amount of time to expiration. It's the same stock, so the expectation for the future should be the same. The interest rates are the same. All the factors that implies options pricings are the same, and therefore the cost of the put should be 0.5, assuming no dividends and things like that. But the reality is that when you look at an option chain, sometimes it's not the case. Sometimes puts are more expensive than calls. Sometimes calls are more expensive than puts. So sometimes you start seeing changes throughout an option chain. When you look at the option chain, all the way throughout multiple strikes that are relevant, throughout multiple expiration days that are relevant, and you start seeing differences. Okay, and here is a question for you. Okay, and you'll see where I'm going with this. Here is a question for you. So, why would you say is the only reason? Okay, assuming that there is no dividends and things like that, what would you say is the only reason for the calls to, at some point, be more expensive than the puts, or for the puts at some point to be more expensive than the calls? What's the only reason that could make that happen? Okay, and Joe, the skew is a different story. Okay, so we'll talk about skew. We have a skew tool as well here that we will utilize at some point. And you'll be able to look at the options from different strikes and basically chart, what their skews are, and basically plot volatility smiles and volatility frowns, and identify strikes that may be more convenient than other. We'll do a lot of fancy stuff that we've been doing manually. We'll do it in a way that is way faster and more efficient. Basically, the skew has to do with how the implied volatility changes throughout the strikes of an option chain. And normally most of the options, okay, they would have that smile, okay, that and we'll talk about this. But right now I'm not talking about this. I'm talking about, let's say you look at all the options across the board, not all, but the ones that are more relevant, and you were to realize that calls are more expensive than puts, or puts are more expensive than calls across the board. Okay, what would be the only reason for that to be? Okay, and Mario said trend dynamics. Okay, and I get where you're going, and you make sense. Nice design. Thank you very much, Joe. No one else. It's adventuring an answer to this question. Bias in expected direction. Exactly, Maka. Exactly. Think about it. There is a formula in options trading, which is long stock equal long call minus put, right? So if you buy a call, if you buy a call and you sell a put, you created a synthetic long position, which is equivalent to being long the stock. Okay. So in other words, let's say so many people, okay, let's say many people are into buying that call. So many people are buying the call, right? So what's going to happen if everybody's buying the call? Well, that call is going to gain value because everybody's buying it, correct? No matter what the theoretical value for the option is, if people keep placing buy orders on the call, that option is going to start gaining value. And what happens if the call becomes significantly greater in value compared to the put? Well, it creates an arbitrage opportunity, because now what you could do is basically be on the other side by using stocks and puts, to offset the fact that the call is gaining value, right? So another way to say that is, if someone is buying a lot of the calls, okay, it creates an effect on the option chain that will tend to neutralize all the option chain across the board. But what if the bias, the directional bias that Maka was referring, is so great that people keep buying calls even more than what the market makers are, able to offset by entering into arbitrage trades to offset, the fact that the calls are becoming more expensive than the puts. So what does represent? Well, it really represents a very, very strong bias in the direction. Many calls are being bought behind the scenes. And by the way, they are being bought, they are not being sold, because if many calls were being sold, then the calls would become cheaper than the puts. That was not my question. My question was, what if the calls are more expensive than the puts? Well, it means there is a lot of buying of the calls and maybe nothing on the puts, or maybe a lot of buying on the calls and a lot of selling on the puts. And both, if there is a lot of buying on the calls or there is a lot of selling on the puts, both is a bullish thing to be done. So it's kind of like the stock may not be moving yet, but there are many people happy to buy the right to buy the stock, and many people happy to be assigned and be put the stock to them, which is a directional bias being, kind of like build a directional bias that is building up behind the scenes. This is not something that you would see on the chart. This is something that is happening in the derivative markets, in this case options, and you would be able to measure it if you were to forget about UFOs and climate in this case and simply focus on the implied volatility of the options. Okay, this is exactly what this is showing you. The blue line is showing you the implied volatility of the calls, and the gray line is showing you the real-time implied volatility of the puts. So what happens? Okay, what happens when you got a greater, okay, and significantly greater, because right now it's kind of, the calls are 12 and the puts are 1167, so it's about the same. But what happens when the call is significantly greater than the puts? Okay, well, you can see when the calls are significantly greater than the puts, that's when you get a change of climate from red to blue. Okay, it's not going to happen every single time because the options traders, including the professionals, sometimes they are wrong too, or sometimes there is an event that happens in the market that gets them to basically lose money and their directional bias is now invalidated. But indeed, it's kind of like doing an X-ray to the market and looking to things that we cannot see on the charts, in this case coming from the option chain. Okay, so in other words, something that we'll start incorporating soon in our analysis is, number one, looking at what's going on with the real-time implied volatility of calls and puts separately to be able to understand what's happening behind the scenes. And in parallel, we will also be looking into the options arena even more in depth by loading an options map that will tell you things such as, today we got 1.5 more times puts, 1.6 more times puts. This is one is the same, 1.3 times more puts than calls traded in those various expiration date. Okay, and by the way, that little triangle represents the average volume on the last 5 days for the puts for that stock. In this case is SPY. You can see that we are already surpassing, we've been trading for 2 hours since the market opened, we are already surpassing the average volume in the last 5 days when it comes to puts. And again, it's more puts than calls that are traded. Here it's even more exaggerated. We surpass by a lot the average volume of the last 5 days. So in other words, we can start gaining a more in-depth understanding of what's happening behind the scenes. Are people really start hedging, things like that. And again, we're going to be able to utilize all of this information soon in the sessions as well to have our plans and our predictions to be even more accurate. Okay, let me see your comments here. How are you, Joanne? It's good to see you. Okay, but you're here now. All good. Ahmed, good to see you as well. No more questions that I missed? No. Okay, good. Perfect. Okay, cool. Now, what else are we going to be able to do? So we're going to be able to, switch from volume to sorry guys, here, from volume to open interest, okay? And then we're gonna be able to see what are the strike prices of the options that have the greatest open interest across time frames, okay? For example, here, you can see there is plenty of open interest here, plenty of open interest here, plenty of here, more than other strikes. So in other words, this is aligned with the chart prices, meaning that the 437 strike is being seen as a relevant strike. And guess what? If there was a UFO at this price point on the chart, that would make that UFO even more relevant, right? And let's say you are planning on an iron condor and you are setting the top and the bottom of the range. So all of this is going to help us to set up ranges that are even stronger than what we have been doing so far, which I'm not saying it was a bad thing at all. But again, we're gonna dig a little deeper. And the digging that I'm talking about is digging that won't be done on the chart. I mean, it will be done on the chart, but it will be information not coming from the candles, but information coming from the options data, which is being put together in a way that can be processed visually very easily. Okay, and not only that, we're gonna have tools to scan real time. You're gonna be so happy, Mark, because all the scanners run on the server side, not on the client side. So you don't need to click a run button and wait. It's all processed at the speed of the light on the servers. Okay, so you will get real time results. Again, very very quickly. So anyway, I could spend hours just going through the software. Okay, so we'll talk about that one step at a time. I'm gonna go back to TradeStation and continue with our day, but just know that we're gonna start adding little by little more in-depth understanding of the markets, both from a charting point of view, planning point of view, directional bias point of view, UFO quality point of view, range point of view, target point of view, all of those point of views, which is information we get from a chart. We're gonna get finer and finer at that, but then there are millions of options analytic tools that are gonna help us to plan the trades much quicker. Many of those tools actually will be similar to a wizard, where basically you input your target price or your range price, and it's gonna populate the various combinations for trades, so we can just analyze the ready-to-use combinations already, the ready-to-use strategy with the strikes and the expiration dates that make sense, without having to go through the option chain manually to do all of it, which we'll do it manually from time to time because it's good for learning. But to gain speed in our executions and trade more often, we're gonna take this to the very next level. Okay, so again, this is the first time I am displaying this tool publicly. This is not released yet officially. This is an alpha/beta version. We'll have that finished, let's say 2 weeks from now, 3 weeks from now, something like that. I'll give you more information when the time comes, but it's about to be out of the oven, okay? To be out of the oven. So anyway, I'm super excited. Been working on that for a long time, as you guys know. And Maka is guilty that I got this on the screen today, because you shared with me, Maka, that you have a nice vacation soon and you may miss some of the sessions, and I wanted you to not to miss this. Okay, so anyway, let's get back to our trades. Okay, so we're gonna get back to review the trades that we have running. Thank you so much, Mario, for your comment. Leland Siderman. Yes, Maka. So anyway, so let's talk about what we have. Okay, and first of all, we have work to do, if I'm not mistaken, because Marathon has hit our lower solid line with the market tanking today. Marathon went down by 0.7%, and therefore it's time to look at doing something about this trade. And the one thing to be done is to convert this trade into an iron butterfly, isn't it? So here is Marathon. Okay, currently Marathon is an iron condor, as you probably remember from yesterday. Where are my writings? My writings should be around. I believe I had some writings. Okay, here they are. So yeah, so yesterday we tried to get the 67.5 and 62.5, and we couldn't. Actually, we have that. We tried to get the 61.5 and the 66.5, and we could not. And we said, okay, so if there is a moment in time where the market keeps going down, we're going to have to convert this into an iron condor, which is not super ideal because we like to do it as slowly as possible. If we could do 3-4 steps, 3-4 tweaks before getting into iron butterfly, then the trade may end up actually profitable. If we did one step and the second step is an iron butterfly, so we're going to be, definitely executing our damage control plan, okay, that, damage control mode, which is part of the plan. But again, now we're going to be depending on where the stock ends up trading at on expiration to be profitable or not. In the meantime, we are really going to cut the risk of the trade by as much as we can by doing that conversion from iron butterfly to from iron condor to iron butterfly. I see Siderman, you've done it already and you've got one. Great. So let's see how much I can get myself. So MPC, here we go. So we got MPC currently showing minus $49.5 of loss, which is a bit less than what we see here with minus 87. Okay, why? Because we did an initial tweak. So that initial tweak brought in, I'm not sure what it was, but I would say about $40 or something like that. That's why we got $48.5 of loss. So I'm going to duplicate this trade, okay, and look at what if instead of keeping it the way it is, I'm going to go ahead and on the call side close what I got and make it 55.50. Oh, of course, I didn't change. I'm like, why can't I do it? Okay, of course, because I need to change iron condor to custom to 55 and then 60. Okay, 55 and 60. So I got 50, the 255s in the middle and the 60 above with the calls. Okay, so if I do that, okay, let's find out how much we would get for a roll if we do it now. So we are rolling the call side. Don't get confused because we are being hurt on the put side. So we're not going to close the put now because if we close the put now, we take the pain. So what we're doing is that we are rolling the call down. So the calls are going to help the puts. Okay, that's what we are doing. So we are rolling the calls. And it's going to be the same expiration date, which is July 30. And then we are selling the 55 and we are buying the 60. That's what we're doing. This may provide 113 if I do it now. So, I'm just to be very quick, I'm going to go market. But again, remember, don't do market, do limit. Okay, and take it easy. Take your time to execute. Remember, there is no major rush to get filled. Okay, so let's see how much we get. And we have got 117. Okay, so I got 117. I guess I was a bit lucky there, Mark, because the stock bounced a little bit from that green UFO on the chart. Okay, and I believe there was a green, yeah, exactly, there was a green UFO there on the chart, and therefore this pushed the price a bit higher, and that's why I'm getting 17 cents additional to the ones you got. Okay, so what would be my total credit here? So 0.92 plus 117, that means that now I'm getting this for 209. Okay, so 209 is the credit. Okay, and therefore if I chart it, so now notice that my worst case scenario is to lose 291, okay, where this trade had an initial risk of $400 over. So now it's 291, so we diminish the loss. Okay, and now as long as the stock remains trading between 53 and 57, so then we'll end up in a profit which could be up to 200. Okay, which is more than the initial premium collected, so that's good. The downside is that now our range becomes narrower. Okay, it becomes narrower, and therefore the probability of ending up in that narrower range is obviously less. But it's a good defensive move, okay, for us to now be defended between 53 and 57. So let's go ahead and let me update this on the chart. I'm going to draw a blue box like I normally do in cases like that, which is going to be 57 to 53. It's going to be something like that. Let me change the color and then also change the prices. So 57 to 53. So it's something like that. Okay, so now we need the stock to stay there. Okay, and what probabilities say is that stock, I'm just going to close the Iron Condor. Okay, so I'm just left with what I have, which is the Iron Butterfly. So probability say that stock may move to 59 and may move to 51. Okay, so in other words, it is not so likely to stay there. Okay, price may move beyond from 51 to 59. Okay, so 51 is all the way here, and 59 is somewhere here. Okay, so in other words, there is all that area here and all that area here, which represents the risk of the trade. But at least it's not like we are just accepting taking close to $400 loss. We are now converting that risk down to 290 something, and we're giving this trade another chance, okay, to make us happy by staying in the blue area now instead of the purple area. Okay, so this is an action to be taken as long as you follow the risk management rule I present in the sessions. So this is an action to be taken, and it's to be taken now because the condition has been met when the solid line below was hit just a little earlier in the day. Okay, so trade has now been converted. We are in damage control mode with MPC. Let me see. Okay. Yeah, just great. Just catching up with the messages and so on. So make sure everybody's with me. Great. Okay. So what about MDT? MDT was looking very well yesterday. So let's see today. Okay. So MDT, moved down aggressively, 1.5% down. So of course the statistics now are going to be different. Notice that yesterday we were not supposed to reach 125 and we just did. Okay. So I mean, statistics are statistics. A very good reference, very smart thing to be done, but it's not a guarantee, right? So 128 to 123.5, it's kind of like what we have now. So 123.5, it's somewhere here. Okay, and the other one I said was what? 128. Okay, so this is the new statistical range based on probabilities. And indeed, it seems that we're gonna very nicely end up in the purple area from today until tomorrow. So this trade, is very likely going to end up as a profit. Remember, I don't have this trade in the account, but we did plan it, and I believe some of you are executing it. I remember mentioning this trade as a good trade to practice because the risk was very low, the profit too. But yeah, again, a good trade to see the process. PayPal. Speed of the light. I said everything I had to say about PayPal yesterday. There is nothing that we need to do. Again, as long as that stock is above 262.5, we're gonna lose the amount of money we said was going to be the loss, which is $430. Okay, so this is what will end up happening. Of course, if you look at my Thinkorswim now, it shows that this trade is making $2,500. Remember, it's not like that. Okay, it is not like that because we need to add up all the prior trades that we closed that are part of the trade as trade managements and tweaks that we did throughout the life of the trade. And if you add it all together, so again, 430, negative 430 is the result of PayPal. So nothing to add unless you guys have questions. I'll just keep going through the next one. AMD is a trade that I closed yesterday. Notice is not in my account anymore. And I believe you probably are in the same position. I believe Umaka maybe had sold a call against AMD, if I'm not mistaken. Okay. And then the last one to comment is Lily, which Lily went down by 1.4%. That obviously not too good for this trade because the maximum profit, if you did nothing, was to have that stock to be above 240 on expiration and after expiration. Meaning that the fact that the stock is dropping 1.4 today is making it less likely, and that is making our decision yesterday of having the roll, right? We ended up moving 230, 240 to 230 to 32.5. So that was a good call. Okay, it was a good call, and therefore this trade is likely going to end up in the situation that we defined yesterday, with a maximum profit of 867. Currently, it's 769, but theta is moving at the speed of the light, and tomorrow even faster, because at this time we got 1 day and a half to expiration. So this gray curve is becoming steeper and steeper by the hour. Okay, so it needs to be that steep, on expiration day tomorrow. So it's becoming steeper. So that theta value, which is $25 per day, is going to become greater as the day progresses. Okay, so so far all good, and really, nothing else to say. We just leave it alone until tomorrow, and whatever we collected, so that's what was collected. Okay, so that's Lily, and therefore I'm done with reviewing the trades, and it's time to trade new opportunities now. I'd like to. Oh, you are in the SKT, and you know what, Siderman, I saw your message the other day, and then I forgot to comment on that, and I don't have this trade, and I don't remember exactly what this trade was about. Oh, I can see that was a directional trade then with a calendar, isn't it? Yes, I think so. With August and July. Siderman, if you don't mind to type on the, let me write it here, SKT. If you don't mind to type on the chat box exactly the units you got and the prices you got, I can certainly put that in the simulator and guide you into what to do, because I did not get filled myself, but it seems that you did. I guess you did it the day after, because I remember placing a day order. So if I did not get filled, I guess that the condition was not met on that day, but maybe it was met the day after. So please let me know about your entry date and your prices and your strikes and everything, and I can review that at the end. Okay, cool. So anyway, so let's get back to looking at trades, and therefore we're going to start with a non-directional scan, sort from higher price to lesser price, and begin planning on the trades. Okay, so we're going to look at BioNTech, and we're going to start looking at this opportunity and see what can be done with this trade. Well, first thing first, okay, you can see earnings are happening on August 10, okay? And so again, the goal for the trades I have in the scanner, right? And this is a little recap for the ones of you that have not been around for a while, and maybe you missed some of the explanations related to the double calendars, so you can kind of catch up a little bit. So the goal is to set up an non-directional trade that profits from the fact that implied volatility will rise as the earnings of this company will approach. The earnings of this company will approach on A10. So we will want to use that expiration date to buy options, because we would expect premiums to rally because of the implied volatility growing as the earnings dates approaches. But then the calendar is done by buying options and selling options from a prior expiration date. And then we need to find a prior expiration date that gives us what I call that arbitrage opportunity. Okay, and by the way, Joe, this is when the skew will be very useful to us. So in any case, let's do what we have been doing. Okay, and so if I load TradeStation, I look at August 13, which is where the earnings are or will be priced in. So you can see this expiration date has currently 59% of implied volatility, where the front week got 49 only. So in other words, there is no arbitrage opportunity. What I'm looking for is that number to be equal or greater than this. That way, the option I'm going to sell, is a very good starting point where I am collecting, at least in a proportion basis, I am collecting just as much premium from an extrinsic value point of view than the option I'm buying on the longer term expiration. And therefore, it's a good starting point. It's not a true arbitrage opportunity, but I'm calling it like that because, I think we understand each other if I call it like that. And it's kind of like a simplistic way to think about it. Okay, but we don't have this here because the front week, it's too cheap compared to August 13. Okay, so therefore, we're gonna move to the next one here with Best Buy. Have a sip of water, guys. Okay, so this is Best Buy, and Best Buy has earnings on August 24. That may be better. Let's take a look. August 24, we got August 27 there. This provides 33% volatility and the front week is 25. So still, we got too little implied volatility in the front week compared to what we have in August 27. So not good. Okay, so we're gonna have to go to the next one, which is LEN. Okay, target is 1945, Siderman, very good. Give me more information about the specific strikes you have, the day you got filled, and the prices you got, okay? Now, so Leonard got earnings on September 13, and that's exciting because, again, typically to be able to find that arbitrage opportunity and also to be able to do tweak over tweak over tweak over tweak, you need multiple weeks in between today and the earnings, okay? And September seems quite far. So we may have one here, okay? Let's take a look. So what did they say? September what? September 13. So September 17 is the one, okay, which is providing 32%. Oh, and funnily, I thought this one may have worked. The front week is providing only 27, okay? So, I mean, this is to keep on the radar, okay? Because if the market was to fall heavily and everybody gets scared, probably you would see that 27 to become 30 something, and now you have the arbitrage opportunity, okay? But yeah, so at the moment we don't. I thought maybe with September we would. Micron, so let's see what happened with this. September 28, okay? September 28. So let's take a look at those options with Micron. September 28, the nearest we have is September 17, and we got 33 and 30.5. You know what? I am keen to look at 33 and 32.6. Okay? Okay? Let's see. Okay, let's see. Also, this is where let me give you a mini lesson here. Okay, coming back to Joe's comment earlier. So when we talk about volatility smile, so if you look at the at-the-money strike, you got implied volatility of 29. And as you go up, 29 becomes 31, 33, 35, 36, 40. And as you go down, 29 becomes 30, 31, 32, 33, 34. So in other words, if you were to make this, kind of horizontal instead of vertical, it would look like that. Okay, and now if you turn it right, so now that's your smile. So again, when we do the double calendar, okay, while this tool with TradeStation is showing me 30.49, so I guess you are with me that this is taking into consideration these values and these values, and maybe a bit more, because all of this looks to me like more 29. So if he's looking at 30, it's because he's taking a few more values. But basically, the weight that is being given to this calculation is basically proportional to delta, and therefore this value may or may not represent what I'm looking for, because when I'm looking at the 17, so let's say the strike selected for this trade were to be, were to be 70 and 85. So then the values I got is 31 and 33 versus 29 and 30. Okay, so it's actually not good enough. Okay, it looks, oh sorry, I'm using the wrong expression date. It was the next one. Okay, yeah, 30 and 30, 30 and 30 versus 33 and 33. Well, it's not as good as what you would think when you look at 33 and 32. Okay, so the best way to see that really will be when we use tools like the skew, where we'll be able to look at the specific strikes. Okay, so you would load that this is Micron, and here we would then select the expression dates we want. Okay, for example, we want September 17, show me that. Okay, and then we also want, for example, July 23. So what happens? Okay, and if I do that, so you will see, which strikes are above and below. And you can see actually the 70 something strike has more implied volatility on the front week that on the September 17, which is the gray color one. So again, we'll be able to filter out for those those arbitrage opportunity based on strikes by being able to chart the so-called smiles instead of just looking at a number, which is a good reference, and it works well, to be honest. I mean, we had good trades by doing so, but then we're going to be able to be more precise, okay? In any case, I don't want to overwhelm you too much today. So let's go back to what we are looking at, which is the next symbol, BHP, and see if that provides what we need. Okay, so earnings August 10. Okay, so when earnings are so close, typically it won't work. So yeah, on top of that, we don't have weeklies with BHP, so forget about it. And then JD, earnings 816. So 816 will be 820, and look at that. This is good. So 820 is 35, and the from week is 34.75. Let's say close enough. Okay, so we may have an option here to put together a trade that may work for us. Okay, so let's go ahead and take a look at this. And the way we're gonna put the trade together, let me see how much time I got. 15 minutes, great. So the way we're gonna put the trade together, and here we got 45%. Pre and post market is providing us with 45%. Okay, so we have to pass, my friends, because we don't have the minimum 48% we're required to be able to take the trade. Okay, so we're gonna have to pass, and it's a bit sad because we have what we need from the options arena, but the chart, the underlying asset, does not provide the directional information that we need to set a range, and therefore we are just gonna pass. Okay, so no non-directional trade today. And since we got 15 minutes left, I'm gonna focus on the directional ones, which are often a bit quicker to plan. And since the market it's getting ready to turn, so I'm gonna look at shorting opportunities and see if we can plan on a nice short to offset the trade with Lily, which is long in the portfolio. So let's begin with BioNTech. Siderman, 5 contracts, great. Looking into that in a minute. Great. Mario, how about setting up a straddle or a strangle before earnings to enjoy then the increase in volatility? Is this so costly? Yeah. This is basically what everybody does. And those strangles become so expensive that unless you get a humongous move, they will not pay you. So it's the recipe to get many disappointments and, once in a while, a good trade. That's not an efficient way to play earnings while it's promoted by millions of YouTube videos and brokers because it's good commissions for them. And I mean, if you buy a strangle, the most you can lose is limited, so it's not that risky for clients, but making money with it is very difficult. And therefore, you may say, I may be reading your mind and you're thinking, so what about we sell the strangle or we sell the straddle, right? If the long doesn't work much, so what about we sell it, right? And then, so the opposite is true. Then you make money many, many times, but then the one time the stock moves crazy on earnings, you get completely killed, right? So it's a tough one to play earnings unless you build up into it the way we are doing with these trades. These trades are not an earning play, okay? These trades are not an earning play, but they are one way to benefit from the increase of volatility that will take place as earnings approach. Okay, but notice that we are putting the trade weeks in advance. Okay, so it's not, I would not call this an earnings play. Yeah, so anyway, so what do we have here? So if we want to be directional, well, we cannot. Okay, why not? Because while the climate is down, the stock is trading above the average, so then we cannot use any reference. So let's go for the next one, Novavax. So what's happening? By the way, little flash of things that we're gonna start doing as well. when we are looking for trades, we will also be looking at the groups in the market. Okay, we'll be looking at basic materials, financial, consumer goods, healthcare, industrials, and we're going to be picking stocks that belong to sectors that are already moving in a specific direction. We're going to be scanning for that, okay, in ways that are quite powerful. Okay, we'll use a matrix. Okay, actually I have one loaded already, so we'll use a matrix, and not this one, and basically we'll come in here and putting on the side all those scanners, which I'll go through at some point. We're going to be looking at stock filters, and we'll be looking at sectors that are moving down in the long term, moving down in the midterm, and stocks that are down in the midterm as well. And basically we're going to be looking at stocks that are in a down climate, but also the sectors and the industries where those stocks belong are also in a downtrend in the long term and the midterm. So when we scan for that, that's it. Those are the ones. And then on top of that, we're going to add some options, additional filtering criteria to make it even better. And those trades are going to be very nice. Okay, because not only you heard me a million times say stocks are a fragile thing because they depend on many factors which are external to the stock itself. Like competitor companies, sectors, the industries, the S&P itself. Well, by filtering stocks and filtering stocks with their groups and industries all together, we're going to be able to end up with opportunities that have more odds, because we are not relying on the stock only. If the stock UFO was to fail, then you're going to have the UFOs and the trend of the whole industry and the group. Okay, so that will very likely help. So with Novavax, we are not getting our 50% there, so we're going to have to pass. With Lenar, 45. If I look at regular session, it becomes 52, so this is good. And with Lenar, the only problem, and we're not going to take it, is that the climate is being down for 5 candles. But unfortunately, statistics suggest that 4 is a normal thing to happen, meaning 5, it's too much. And now you are stepping into the potentially not sustainable territory. And therefore, planning on this trade would probably end up not working well. And it's a shame because we got UFOs and everything, but yeah, the climate is against the trade, so we're not going to force it. Micron provides 50%, so that's acceptable. 9 out of 4, that is not acceptable. WBA, let's take a look. 47%, well, it's loading still. In any case, 9 out of 5, so that stock, it's been moving down for too long. BAC, Bank of America, let me go back to Novavax because actually, yeah, I'm using the right settings. 2 out of 5, so this is good. So let's see Bank of America as it loads, if we have what we need. Okay, 53%, that's good. My friends, we have a trade. Let me look at pre and post market. It's 54. That also works. And in both cases, I am looking at UFOs around 3980, and this is perfect. Okay, so I'm just going to use this chart. The pre-post market is good enough. So the entry price for our trade would be 39.77. Okay, so 39.77. It's going to be, is this Bank of America? Yeah, TradeStation is back to do what it used to do years ago. When you link the Options Station Pro to your chart symbol and you switch too often, then it loses the upper bar with the symbol. So I don't know what I got in the option chain, so I'm just gonna reload it. So my friends, it's looking like we're gonna extend by a little bit because I need to plan this trade and then I need to review mark trade. So just know that. So the entry for this trade is going to be 39.77. 39.77. And the target for this trade, okay, the target for this trade, go for a daily time frame, is going to be that UFO, which is 3605. Okay, 3605. That's the entry and the target. Okay, so now earnings, no data available. Interesting. BAC. So earnings for BAC, yeah, they just happened. That's why it's not available on TradeStation. So they happened yesterday on that date, 6:30. Sorry, 7:14. So that was yesterday. And yeah, so the next date is not reported yet, as you can see. Okay, you see we have the earnings reports on the chart on top. So this is good and bad. It's good in the sense that we got plenty of time to get to the target, no distortion from the earnings showing up in the middle of the trade. But normally when we buy options, we like to buy options using the expiration date that coincides with earnings. That way, if the trade was to move very slowly towards the target, so then we would end up in a position where you could benefit from the increase. You could benefit from the increase of implied volatility on that expiration date, which would kind of offset some of the pain on theta, because time is passing, decaying the options, and the stock is moving slowly, so there is a lot of loss on theta. Now we cannot do that with Bank of America because we don't know the next date for earnings. I mean, we could predict or guess, but we're not going to be able to be precise. So in that sense, I'm going to plan the trade differently. Okay, I'm going to use a butterfly strategy, not an arrow butterfly. I'm going to use a butterfly strategy, which is a strategy which is directional. It's going to be a put butterfly, where we're going to be making money as the market falls. Okay, and the beauty of that strategy is that we're going to kind of neutralize a lot the effects of time passing as well as the effects of implied volatility changing, because we cannot do too much. Okay, and Bank of America is fairly liquid. This is going to use 4 options, but Bank of America is fairly liquid, so I'm okay with that. Okay, so the one thing I want to do is look at how much time I need to get to the target. Okay, how much time I need to get to the target. Okay, this is something that we're gonna have automated with top, where we said the target is what, 3605. So here I'm gonna type 3605. Okay, and it's gonna tell me, okay, the target date is August 22nd. So this is how long it's gonna take to get to the target. And by the way, you saw it just build all the option strategies for us. Okay, but I won't talk about this. I'm just talking about the date. So August 22nd is the date for the target. So with that in mind, I need to pick an expiration date which is August 22nd or more. Okay, and the next one is weekly. So to minimize the problem of slippage that are not too bad on Bank of America, but are better with monthly expiration dates, I'm going to use September 64 to do my put butterfly. So I'm analyzing a butterfly, not an iron butterfly, a butterfly made of puts. And I'm going to have to set this trade properly. Notice a butterfly is made of buying a put, selling 2 puts, and buying a put. Okay, so we're using 3 strikes, even though it's 4 options. You may need to then go back and rewatch the recording, guys, because it's a lot of, it's new, okay? But anyway, the rules that we're going to use are, to be honest, quite similar. So first, we know our target. It's going to be 36. So I'm going to have to push this below. Let me start with 30. What if I do 30, 35? And then 30, 35, and then I would do 40. Well, actually, I should go a bit lower than that, okay? But if I do that, notice that my delta is about 30, which is what I normally shoot for. Okay, this is what normally I get. Okay, I would like to have a bit more delta if possible. So what I'm going to do is, if I do 34 and then I do 28, yeah, that's better. So I got my 31 delta. Okay, actually it's not better. Let me go back to where I was. Yeah, this is better. Why is this better? Well, because I'm very close to the 30 delta I want. Okay, I know it's not there, but it's close. Okay, but why am I trying to find a balanced situation? Because I want to minimize theta, and also I want to minimize vega. Why? Because I cannot rely on the expiration date that lines up with earning, because I don't know the earnings date. So then I want to neutralize this as much as I can while I'm still enjoying a positive gamma position at the beginning. Notice later it becomes negative, actually very negative. So we're going to have to work on this trade as the trade progresses, and we will. But basically, that's what we're going to do in this stage, which is to build, a put butterfly using 40, 35, and 30 strikes. And that is the trade that we're going to take now with an activation rule only if the stock rallies to 39.77. Okay, this is not to be taken now. And that would cost 100, let's call it $130. So that would be the risk of the trade in case, we get filled when that stock reaches the entry point with a red UFO on the chart. So let's place the order because it's basically time to end the session and I still need to review Mark. So we are trading Bank of America. We are using September expiration. We are using a butterfly made of puts, where the strikes we buy are from top to bottom 40, 35, and 30. Okay, with a debit of 144 if you do it now, but we are not going to do it now. Okay, we're not going to do it now. Again, recommended is to set an alert so you can negotiate your entry. Okay, in my case, just to guarantee I get it filled so we can practice it and discuss it as the trade progresses, I'm going to use a market order, but not by itself. I'm going to use a market order with an activation rule, careful with the trigger, greater than or equal to 39.77. Okay, and let's not be overconfident. 39.77, double checking. So this is the trade. This is the activation rule. The trade is a day order because if I don't get filled today, I need to revalidate this tomorrow. Probably valid tomorrow still, but I will need to revalidate tomorrow, and therefore day order is the way to go. So I'm going to click save, confirm and send, okay, and we have there Bank of America waiting to get filled. If you want to take a screenshot, this is your opportunity, and from there I'm going to get Siderman parameters in a simulation window, discuss it, and we'll be done for the day, guys. Okay, and yeah, lots of information today. No split, Joe? What do you mean with split? Not sure about what you mean with a split. Sorry for that. If you could clarify that for me, please. Okay, so now let's move to SKT. So SKT, okay, so we had this trade plan the other day. So Mark, you got filled. You got filled. Okay, I think you, oh yeah, on 7-2. Okay, good. So 7-2. Yeah, okay, so got it. So that was the day after we planned the trade. Okay, very good. So that's when you got filled. The market, ideally the market would go back higher. It didn't. Remember, it was a calendar spread done in a directional fashion, buying the 20 call and selling the 20 call. You used 16th of July and 20th of August expiration. Very good. So let's do that. I still have it here. Great. Perfect. And you paid a debit of 67. Okay. And therefore the trade is currently breaking even. Okay. So this is what you should be able to see at this moment in time. You are currently breaking even. Okay. Now, what to do with this trade? Well, yeah, you did very well bringing this back to my attention, Mark, because there is. Oh yes, Joe. For the split of the bid ask, what I said is, I'm using a market order, so I get it filled on the account I use for the sessions, so I don't miss it. Okay, but for you guys, I was suggesting to either use an intelligent order or go ahead and place an alert, and then of course at the time of the fill, make sure you negotiate your spread, so split it. Yeah, definitely. Okay, yeah, good one. So now, Mark, what should you do with this trade? Okay, there is no weeklies. There are no weeklies. Okay, so that was a one-shot type of trade. Okay, got it. Got it. Okay, so the only way you can do to this trade is to alleviate the pain and convert it into something that may become a profit if the stock in the end ends up moving higher, which it should. Climate is up for that stock, so you may get to see that stock go back higher. So how can you work on improving this trade? Okay, how can you work on improving this trade? Well, the way to work on improving this trade would be to go ahead, if you got multiple expiration dates, so multiple weekly expiration dates, you would take the 20 call that you sold and you would sell a new 20 call using July 23, which is next Friday. But that doesn't exist. So then what's the only thing you can do? Okay, so then the only thing you can do is to sell a call above the call you have with the August expiration. Therefore, you're gonna be doing this. Okay, you're gonna be closing, you're gonna let the 20 call expire. Okay, and then on Monday, you go ahead and you sell the 21 call. Take a look at what is the effect of doing that. 21 call that expires on August. So take a look. If I sell the 21 call, which is my line below, right? And my calendar spread got no 20 call anymore. So basically you are converting your calendar spread into a debit spread, a classical vertical spread, where if you're wrong, you're gonna lose 22, which is $67, minus the credit you will collect on Monday from the 21 call, which right now is 45, maybe on Monday is 48, maybe on Monday is 35, I don't know. But so whatever you pay minus the credit is gonna be the maximum risk. And if the stocks end up moving higher and ends up surpassing 21, so then what's going to happen is that now you can make up to 78. So in other words, damage control. You take a $67 risk trade and you just converted it into a $20 risk trade. So it's damage control. And then you give the trade another chance until August expiration to move higher and hopefully get you back into profit. And if it goes above 21, you're going to make the full profit of 78. So that would be the play to be done with the failed calendar spread, the failed directional calendar spread, because the stock did not behave directionally. The stock actually went in the opposite direction. Now, there is one thing for you to know, and that's why you need to do this on Monday, not today. So, the stock is currently trading at 19. Okay? If the stock remains here, or if the stock remains below 20, that call will expire worthless. So on Monday, you will have a 20 call, and then you can go ahead and sell the 21 call. And now you have your 2021 call. That's it. Okay? But what if the stock rallies crazy tomorrow? Okay, what if the stock rallies crazy tomorrow and gets above? Okay, well, then good news and bad news. So what's the good news? Well, the good news is that now your calendar spread, okay, if I uncheck the 21 call and I re-add the -1. So now the calendar spread, if the stock rallies, okay, tomorrow, so you'll be able to close it at some point up to, maybe you make $40, okay, and then you'll be able to close the trade for a profit. But if you get distracted and you don't close it, and the stock is above 20 on Friday expiration, if you get distracted, then that 20 call will get you a sign. So on Monday, on Saturday, I should say, you would find yourself, okay, long the 20 call and short 100 shares of stock, which they neutralize each other. It's not a big deal. But from a margin point of view, the 100 shares that you're short require much more capital, okay, than doing a spread. So just make sure you have capital for that. Just make sure you watch it. On Friday, if the stock rallies hard, make sure you close it so you avoid assignment, and that's it. But if it doesn't, okay, and it remains below 20, so then that 20 call will be gone over the weekend. So then on Monday, go ahead and sell the 21 call, and you converted your calendar into a classical bull call spread. That is the play, and very, very well done by asking, because I got distracted the other day and I was not able to answer this for you, Siderman, and of course you needed this overview. Let me know if this is clear or not. Of course, this is recorded. You can always review and re-listen to it as well, but since we are here, let me know. Happy to re-explain it quickly. Joe, does your new platform include a pop-up of you shaking your head if we attempt to place a bad trade? I love your humor, Joe. You know what? That's a good feature. We're gonna make a note of this feature. Okay, I have a very, very good friend that some of you may know. His name is Reynaldo Soriano, which is one of our coaches as well. He does the psychology sessions. I hope you guys don't miss those sessions. The guy is amazing. He was my first ever coach when I started trading. And Reynaldo is a very good friend of mine. And there was one time we were both having such a fun time laughing and talking about the mistakes we made when we were learning how to trade and things like that, and how healthy it would be to have a slapping machine, which is a device you put on top of your monitor, and if you take a bad trade, it slaps you on the face. So anyway, not sure if you find it funny or not, but we find it very, very funny. We were laughing very much, and the evolution of that idea is today with with the technology and the drones and everything. I think that brokers should create some sort of a device that if traders are not trading well, they should send a drone to their place and kind of send a message to them about behaving in front of the trading platform. But anyway, just probably a bad joke. Maybe you're laughing. I'm not sure. Anyway, guys, just remembering good times from my early stages when I was learning. Anyway, guys, hopefully the session went well for you guys. Feel free to share thoughts with me, or just share with me, shoot me an email from time to time and tell me how is it going. And you've seen a little bit of top. So, if you have any views, I need to obviously spend more time and, illustrate the points better. But you had a little bit of a first impression. So let me know if you have any comments about that too as well, because, the beauty is that this is our platform. It does not depend on brokers or anything like that, meaning that, we'll be building tools and, making those tools as adapted as possible to the community, guys. Okay, so definitely looking forward to listening to all of your suggestions and more. Okay, very nice. Joanne, you found it funny. How long did it take you to learn? A few years, I would say. It's when I really felt strong. Yeah, but then you are learning all your life. Okay, you always find, especially with options, there are always nuances and aha moments that you get throughout the years. So yeah, it's this is just like playing tennis, right? You get to a point where you can have fun playing the game, but you may not win all the time, and there is a moment in time where actually you win more often than not, and now it's even more fun, right? So it's kind of the same. So it's there's always room for improvement, guys. Can't wait to use it. Look great. Love it. Yes, of course, Siderman. Anything you can do to make our community and our tools known to other people out there in the world, for sure, because we strongly believe what we do is helpful. for the people that take trading seriously, of course, for the ones out there that are looking at becoming a millionaire in a week. So it doesn't matter how good the tools are; it's just not going to happen. So the we prefer not to have that type of profile or mindset, that type of mindset among our traders. But for the ones that are very serious traders, certainly. Share. Why not? Definitely, we would certainly appreciate that, and the greater and the bigger the community, the more things we can do. So certainly share. Yeah, don't stop yourself from sharing. And also, by the way, I don't mean to be mean to the ones that are not taking trading seriously. Sometimes I found many great guys that thought you could actually become millionaire in a week because they heard it somewhere, someone told them. And because we don't know what we don't know in life, it's just like if we talk about anything, food related, health related, universe related, I don't know, there are so many things we don't know. So everybody deserves, let's say, a second chance, if you wish. So someone that didn't take trading seriously join our community and may realize that, oh wow, that's serious stuff, this is professional. So let's you know realign myself and refocus. Okay, so yeah, guys, long story short, may share with your people, and let's make this community a great one. Anyway, everybody, yeah, 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 great. So yeah, just reading the various chat boxes. Great, everybody, my friends, my pleasure as always. I will see you next week. Keep up the good work. See you then. See you soon. Bye bye. Take care, everyone.